Welcome to the Tech Today podcast. It's your host, John Mayetta. So here is CPI. So month to month, all items have accelerated here. January over December, 0.3 versus 0.2. 3.1% over the year. That's all items. Food continues to tick up. Food is the one that the Fed just refuses to talk about. Not only does food as a category, not only do prices continue to climb, but it's a bigger category than what it's weighted in the CPI calculation. So in other words, it's more of the average family's budget, in my view, versus how it's weighted. Under CPI, I think it was 13% last month. We can maybe look in a minute for this month. Energy down. All items less food and energy, i.e. core, accelerated. That's at 3.9. And if we toggle, let's see if this lets me toggle. Here is, so this was the inflation now numbers for both core CPI and headline. Core CPI was 0.32 for January. That's month over month and year over year, 3.81. New vehicles flattish. That's probably directionally correct. Used cars and trucks down 3 points. That's sort of for vehicles. I sort of look at the folks over at Car Gurus put out an index, and directionally these numbers, if I recall, are sort of in line with what I see on Car Gurus. Services ought to be stubborn. Yeah, services tick up. 0.7 for the month. Shelter continues to tick up. Now, if commercial real estate bottoms out, if the Fed allows that to happen, then that will bleed over into residential. So, shelter, I've written about owner equivalent rent a number of times. It's not not that any of the Fed sample set or the CPI data, I don't want to say that any of it really represents real world data. But the shelter slash housing is quite different than what you would find on Zillow. Let's scroll down. Let's look at some detail. Food. This is one of the tricks that the government does. Food weighted at, call it 14% of CPI. Now, if you think of the average American family, the only thing food is probably a larger expenditure category than 14%. So food, which only goes in one direction, is underweighted. So that's a little trick the federal government will do to massage CPI to make it not look quite so bad. Real world prices, in my view, continue to outpace CPI. But nonetheless, we look at the numbers here. Energy, there's so many variables with geopolitical risk. I would hope energy will come down. with the new administration. One that doesn't penalize the energy companies for producing. Apparel. I'm not looking for anything in particular. In terms of these numbers, I'm just sort of scanning. There's shelter. Owner's equivalent rent of residence, 0.6, that accelerated. So this isn't good. If you're somebody that believed inflation was going to zero, which we've written and I've told you a number of times that inflation is going to be stubborn down here. I don't frankly see the United States getting a 2% CPI without the economy really softening up, without more job losses. And it certainly hasn't felt the effect of the job losses that were announced in January. I'm thinking about some of the tech companies and their large cutbacks. So we've got a way to go, but at some point this year, even if CPI remains sticky between 3 and 4%, at some point the Fed is going to have to pull back on rates because we have 34 plus trillion in debt outstanding, and I believe the banking sector is weak. It is going to be fascinating to watch what happens when the Bank Term Funding Program expires on March 11th. And banks no longer have that crutch. And yet those banks still have these large unrealized losses on their books in terms of the fixed income assets, bonds that they acquired when rates were low, now are below par. So that means they have the value of their collateral is that much less, and they're going to pull back on extending credit. The banks will when that BTFP goes away. Now the Fed's pushing everybody toward the discount window. It wants the banks to borrow from that window. And the Fed's trying to say, hey, there's no stigma attached to borrowing from the window, when in fact there is. It means the bank is in a weakened state. So any of these banks that have large unrealized losses, that pull back on extending credit, that have a little bit less liquidity, well, significantly less liquidity, they're going to be in a position to fail should depositors begin to withdraw money. And that problem is not going away anytime soon, so long as rates remain elevated. These unrealized losses are going to stay on the bank's books. So the only way to really narrow them in a meaningful way is to bring rates in. And so to help the banks is why I've always believed, or at least I shouldn't say always, helping the banks is why I believe the Fed will lower rates. So I think we're going to have a credit event or a potential credit event in the form of the banks. And we're going to see rates come in as a result. Without inflation, without that problem having been solved. And frankly, I believe that those in power want to see a little bit of inflation. They don't want it to become unanchored. They don't want to see 10%, 15%, but 3% and change. That then inflates nominal prices in the economy. That then inflates tax revenue. And so you have more tax revenue to pay down the debt outstanding, or the interest expense on the debt outstanding. So you sort of use inflation to help inflate the debt away. I believe that's always been you'll never hear the Fed talk about that, but that's always been a strategy behind inflation. That's all for now. See you next time.